Good afternoon. This is Jeff Scott, and welcome to this week's version of my weekend review. I'm getting clobbered in fantasy football, so I don't have the heart to watch the game for the next hour. So let's go ahead and do this report. I've titled it Santa versus the Hindenburg Omen. More on that to come. And today is December 7th, 2014. Disclaimer. As always, this is for educational purposes only. I'm a doctor, not a broker, and I am truly independent. No one pays for me to do this, and I have paid for all the tools that I use. I like to call the education that I do, whether it's live or on the video, to about becoming your own guru. And each of us has to identify smart folks that we might want to rely upon for our education. And then perhaps we can create our own style based upon those influences. These are a number of my influences: Woodward and Brown, the heart and soul of HGSI, from the philosophy of the investing; O'Neill, sort of the godfather of growth stock investing, with his disciples Morales and Catcher; Thomas Dorsey, excellent book. Don't be fooled, although it's about point and figure charting, and you may not be interested as you think in that. It's really about sector rotation and top-down investing and using comparative relative strength. Trading for a Living, Alexander Elder, Kerry Lavorne, John Person, a couple of great books, Van Tharp Money Management, and a few others. What I need on my desert isle, I have a lot of programs, but what I'll concentrate on today is TradeStation, Thinkorswim, and Genesis. Although probably won't get much into Genesis during this program, but during the day, Genesis is my go-to live product. I use HGSI for my analysis, EdgeRater also for my analysis, Magenta, Best Choice, and TradeMiner on my seasonality. They all have their benefits, and then MarketSmith. I may go to MarketSmith as we talk for earnings numbers, but I'm not going to do it on the screen. I'll do it on my second monitor to save time. As always, I ask myself, where are we? And everybody, so many pundits say that this has been a tough year, and it has been. There's not been great long-term trends. Whenever we think the market is topped, it goes higher. We've had pullbacks which have been sharp and deep, and once you respond, the market's already going back up. I think we've been living sort of at the top of this pile for some time, and it kind of feels like we're here. It certainly can go higher, and we're in the midst of a pretty nice recovery since mid to late October. There's a lot of concern about getting toppy once again, but we're maybe not there yet. So you have to take the market you get, not the one you think you should have. So last week I was concerned or talked about the impact of low oil prices. For winners, we said truckers, airlines, cruise ships, and places where we like to spend money. And for the most part, I think that was spot on. Losers were oil exploration and services, and those companies who dedicate to shale. I hear lots of different numbers, but it sounds like the shale companies need about $80 oil to break even. And at $65 to $70 oil or less, one wonders whether they shut down, reduce production, or if they just keep on making more and more and more. And that impacts on everybody that supports that industry. A week ago, home builders, utilities, and REITs were working. Not so much perhaps this week. But technology and biotech continue to be strong. As I look this week, what's working, at least what's working today, which is Sunday, prior to the week coming, technology, strong, and biotech. Those two have been the leaders of the market for some time, especially the semiconductors and technology. Banks, both big and small, truckers benefiting from the low oil, as have airlines, and then wealth management. What's not working? Still oil services, base metal, REITs, and steel. Just want, once again, shameless plug, HGSI Doc Florida Summit number 2. It will be February 7th through 9th, 2015 at the Best Western Windsor Gardens Exec Center here in beautiful Palm Beach Gardens. Contact me for more information. This will be a joint program with George Lee and myself. It should be a pretty exciting program. We've got a lot of different things planned, and George and I are already working on upgrading and make the agenda even more special than last year's 2 programs. As always, including registration, I'll feed you and water you, take you out to dinner on Sunday, and provide screen capture videos of everything that we do live. I will be doing 2 pre-meeting webinars. One will be to briefly review the capabilities of HGSI, and number 2, to talk a little bit about the basics of high growth stock investing, the philosophy as taught by Woodward and Brown. This will be good prep work for anybody who's not an HGSI user but wants to participate in the program. As always, I do not go around trying to sell my TradeStation indicator package because then I have to support it. However, what I do like to do is offer it at a deep discount. And if you buy any TradeStation indicators, you'll know that the package is a great deal at $250 to anybody who is a paid registrant of this meeting or of my prior live meetings. This week ahead, last week was the biggie with the blowout employment numbers on Friday. We got claims, continuing claims on the 11th, and which must be Thursday, and then on Friday we got PPI. Earnings are on the right. If you own any of these stocks, then I'm sure they're a big deal to you. On the other hand, it doesn't look like it's a very busy week of earnings. One will be interesting is Francesca's here on Wednesday morning, and the reason they'll be interesting, perhaps more than any other reason, is because they've got a new leader came in and the stock jumped up a lot on Friday, so it may be on a nice run. They actually make money. They're expected to make about $1 this year. They traded about $15. And now on to the charts. So those who have been here before know that what I like to do now is like to take a look at what's been going on the last week to get a sense of what's working and what's not working. So first thing is last week, so I did my watch list that I created last weekend based upon stuff on Saturday, and I looked at performance for a week, looking at again to Saturday, but really end of day Friday, end of day Friday. And first thing is, you notice there's a lot more black than red. So the market was up this week. Now, interestingly, growth stocks really outdid the market itself. And you could see that the S&P 500 was up 1.07%. And if we look at some of our favorite lists, the HGS 100 was up 1.71. The IBD 50 was up 2.06. The stocks that I found as potential buys last week were up 2.08%. The GIF All-Star is a tool within the program that does the work for you, was up 2.2%. And if you look at what's up the top, a couple of MarketSmith groups, some very bullish searches for Metastock, best stocks under $15. So a lot of things that one would expect to do well, stocks 1 to 15 moving up. And what was on the bottom were things that should have been on the bottom. Stocks and groups to the downside, negative earnings growth. Green candle lows are stocks that have pulled back. You're looking for a reversal. 4 reversed, 4 didn't. Potential short sell stocks, 70 to 30 were, and this is actually pretty cool. If you're looking for lists to find for potentially short, this is a smart list within HGSI, and as you can see, 70% of the list traded down, and you were averaged down 1.53 on an up market. So as one would have expected, the lists that were bearish did bearish, and most of the other lists were up for the day. So summary, good week to be long, especially if you're into growth stocks. Here's where it starts to get interesting. I have a feeling that our definition in Edge Rater may not, I think there's a number of definitions of the Hindenburg. And the Hindenburg requires 4 things. It requires both new highs and new lows to be above 2.2%, having moving average, which as I find, the moving average of the index should be higher than it was 50 days ago. McClellan less than 0, and new highs are less than twice the new lows. And if all four of those things are true, then you have a Hindenburg Omen. The Hindenburg Omen does not occur frequently. About 1 out of 4 signals is real. And when you get a Hindenburg Omen, it suggests that there's a heightened chance of a big correction. And we look to see multiple signals fire. So if once you go above 0 on the McClellan, you essentially have reversed your signal. So you notice what we have here is everything but the MA. So 50.48. So that would mean we'd be about 49.98. The MA was, let's see which one. So it's 49.98, and the MA is this one here, the second. 49.98. It was 376.30, and so we're not above on the MA. Now some lists showed that there was a Hindenburg fired, some did not. So within Edge Radar, we have 3 out of 4. However, when I look at HGSI, and let me find the right one here. If I looked at HGSI, we can see that in HGSI, and there's some not confusion, that's a scary word. There's some discussion about what the appropriate list to use, and there's been some changes in data vendors. But you notice there's no red lines until we got to this week when we had 3 out of 5 days paint red. So that's a series of Hindenburgs, which is enough to get me a little bit interested. And what Hindenburgs really mean to me is, well, a high risk that we're going to correct, but it really gives you a sense of the volatility in the stock market. So if we pull down a little bit, we can go back to 2007 and 2000, both in June, July, and October, November, and you can notice how the program in HGSI painted multiple Hindenburgs as we were getting into before the big crash. Now, the market continues to go higher before it rolls over. We had double tops with a higher peak in October than we did on the earlier part of the year. And just to point out, all we've seen here is the first couple. So it should be enough to at least stiffen you up and recognize that we're probably getting into a point of increasing risk. It doesn't mean the market's falling tomorrow. And so here I looked at from June 6th, June of 2006 to date. And you could see there was a firing in October of 06, which nothing happened. There were the peaks in 07, which we just looked at with the Black Swan event. And then ever since that period of time, we have not fired the Hindenburg once. And we did fire them. This is on a weekly chart. So we've had some daily fires, but this is a weekly firing. And it's the first weekly fire that we've had in, I guess, 7 years. Now, does that mean something's happening? I don't know. But it means that I'm going to be aware that something might be happening. And again, more concerned about a correction, but I'm still going to take the market I have. I'm just going to probably lighten up my margin if I have any left, take some profits, get rid of some losers, maybe buy some puts on my long-term positions. But this has to be balanced with the fact that we have the Santa Claus rally. So don't know if it means the end is near, but I have to at least point out that it fired, and whether or not it's real, whether it means something is to be determined. From a buckets perspective, we're 2/3 above the midline of the Bollinger Bands on the S&P 1500. We've got some poking their heads above the upper band. But as you can see, still in the bullish camp there. Now, further things to show you This was what happened a week ago. This is when the oil stock and oil sectors blew up. And you could see the market itself had held up good, 50-50 on above or below the midline. But you had 18% of the stocks, and I suspect the majority of them in either the gold, silver, or oil world were trading below their lower Bollinger Band. I've not seen that pattern before where you sort of had a major but isolated correction in one or two S&P sectors. If you want to see what a hot market looks like, this is a hot overbought market where 88% were above the midline S&P 1500 and 30% were above the upper band. And here's where we bottomed October 10th, and with 84% below the midline and 35% of stocks below the lower band. One thing to point out, we've been in a bear market ever since we started using this tool. So you have to take that into account. But in a bear market, we've been in a bull market, we've been in a bull market ever since we started this tool. And I have to take that into account. But in this bull market, whenever we've looked like this pattern here in the lower left, we've had a pause. We haven't had major corrections. We've had a pause. In a bull market, whenever we've had the pattern on the right, it's been bounce time. So you look at where we are today, and we're neutral. So market can go up or down by the buckets, but in a bull market, it doesn't mean it has to correct because we've got so many stocks trading at the top of their bands. The EN market Woody indicator had gone from green to yellow, and we had a series of kahunas to the downside on December 1st, which is not a positive thing for those of us that are long. But you could see we've had a couple of kahunas to the upside, and we haven't really deteriorated. We have yellows and greens, although unfortunately we have mostly yellows. But you can still be long this market if you desire. I'm not going to go into the various signals right now, but we'll talk about that later. I do want to go and look at seasonality within EdgeRater. Done a great, I still think there's a value in the complete seasonality picture that you get from something like Magenta or Best Choice. But Chris has done a great job of being able to take any list of stocks and asking the question, what do they do in 1 month, 2 months, 3 months, 4 months? You could do it by month of year. I like doing the seasonality now button. So if I look at ETFs, for example, over the next month, you could see that the spiders here are up 11 out of 20 years. That's not, 13 out of 20 years. So that's about 65% that the market goes up from here. That's a nice thing to see. And the average return of 1%. So I guess the point here is that the majority of the ETFs are up more years than not over the next month, sort of the strength of the market with the Santa Claus rally. On this side, I'm able to look at returns over that period of time. And what I see is that metals are up 6% over the next month. Oil and gas exploration, be tough this time, 4%. Biotech, 6 out of 8 years up, 3%. So you can get a sense of what's working, what's not working. You could also do this on stocks. And for example, some that I thought really looked interesting. If I look here, this is number of years of data we have. This group up on top, SXL has been up 12 out of 12 the last 12 years, an average of 5% for the next month. Fiserv and Unilever are both been up 12 out of 12 years. Then you have those that have been up 11 out of 12 years, and a lot of these are growth-related stocks, and maybe Unilever might be one we might want to look at, because I remember that chart from earlier that it looked attractive. Excuse me. On this side, we can get an idea of percentage move in 1 month. Now, I would ignore anything that only has one trading year because that's really probably not a great sample to work with. But just to give an idea, let's look down here. DVAX has been up 9 out of 10 years, and average return over each year has been 42%. Tree.com has been up 5 out of 6 years, average return 30%. Tutor Perini up 9 out of 12, ridiculously big average. Repros Therapeutics been up 11 out of 12 years, make sure I'm in the right group, over the next month with a 25% return. So you can get an idea if there's any unusual strength either in number of years up, as on the left, or 1 month return on the right. All right. Next, I like to look at my TradeStation Elder indicators. I say mine because I own them, but I bought them from Dr. Elder, and I highly recommend, if you like this, that you go to elder.com and you purchase the indicators yourself. They're really inexpensive, and I find them to be extremely useful. So what do I look for? If you've been here before, this is color time. I want to see the color of the bars. A green bar means that it's good, okay for me to buy or short. Buy or hold. A red bar says it's okay to short or hold, but I shouldn't be buying. And a blue bar is pretty much dealer's choice. And I look also for evidence of MACD divergence. I've got buy signals on as well, these magenta lines and blue lines, and these are from person signals, I believe. Let's just take a look and see what I got in here. Yeah, these are person triggers. They're similar to what you can find in Thinkorswim for free. So, NASDAQ. I'm on a person buy signal that came in on Friday. I've got MACD divergence on the weekly. We've been long in the tooth this run. We're up near the top of the upper envelope. Blue, green, blue. You could be buying or selling. I probably wouldn't be shorting the NASDAQ with that weekly green, but I'm aware that with that MACD divergence, we are getting somewhat stretched. Let's take a look at the Dow Jones Industrials. Green, green, and green. Everything looks good. We had a buy signal come in, I guess, on Tuesday, and we've got some MACD divergences. What you can see with all these dots here should tell you that MACD divergences can last for quite some time before you get a change, and all it does is it raises awareness for me that the market's at risk. The Russell, we'll look at it again and show how it's been weaker, but you had a buy signal come in on persons indicators on the Russell Friday, green, green, and green. Shouldn't be shorting the Russell. If you want to be in the Russell, you should be buying. Semiconductors have been leaders. No surprise, green, green, and green with MACD divergence on the weekly. On the E-minis, green, green, and green, MACD divergence galore, also on a buy signal. The NASDAQ 100, blue, green, and blue. There's some NASDAQ 100 stocks like Apple that have me a little nervous, although I did make some money on the short side. That's what I do when I get nervous. S&P 500, blue, green, green, MACD divergence. S&P 100, green, green, and blue. So what do I learn from my elder indicators on that very quick review? I learned that for the most part they look bullish and that you still want to be, I think, focused on the long side, however, recognizing that Hindenburg Omen, which, to be fair, not everybody is a big believer of the Hindenburg Omen. All right, shut that one down. Now I'm going to open up HGSI. And since I resized everything, all right, where'd it go? Uh-oh.
Don't answer it. It's for me.
Oh, sorry about that. My wife didn't realize I'm recording this. Let's see if I can figure out what happened to my warehouse view. All right. Well, this is weird. All right, so I have to, let me just see if I can figure out what happened to that. That is really strange. Let me close it there. All right. Oh, there it is. I found it. Let me minimize this. All right. I apologize if you're hearing the fighting in the background. That's what happens when you got two kids. All right, two kids and a mother-in-law. All right. That was weird, but we're in good shape now. All right, so what I was saying is I have to reshape everything because I changed monitors, and my monitors have different sizes. So the first thing I want to do is come down here to Woodward and Brown user groups, go into Major Market Plus, and top-down analysis, which looks at all price and volume related events. Heavily weights Friday, weights a little bit Monday through Friday, 5 days, and just a little bit the last 3 weeks. All price and volume. I rank them by raw combo and what it tells me what's working and what's not. So on the downside, gold, silver, bonds, commodities, volatility, gas, and oil. And on the upside, small caps this week were leading with the small cap 600. The Russell 2000 was number 9. Big stocks with the Dow, mid caps, Nasdaq. So the major indexes, except for the S&P, were up near the top. The S&P is sort of in the middle, and the dollar is way up there, and the dollar may cause some havoc with some of our stocks as we go forward. I like to look at some of these very quickly. Well, first let's look at 5-day performance. Silver had a big move off the bottom, was up 5%, gold was up 2%, but you could see on Friday they were down. Big losers on the week was volatility and oil. 1-day performance on Friday, the leaders were semiconductors and Russell and the dollar and the small caps, and volatility was a big downer, as was gold, silver, oil, and gas on Friday alone. Let's take a look at our favorites. Let's take a look at the S&P 500. I'll do more analysis on this and then try and go a little bit quicker through the others. All right. Resize it. Try not to lose it this time like I lost the last one. All right, so first thing I noticed, there's no Eurekas or Phoenixes, which are follow-through days. So let me now change this to a easier to see. So all I have here is 8, 17, and 50-day moving averages. The 8-day in magenta is exponential, the 17, 50 in red, and green, blue, and red, 17, 15, 200 are simple moving averages. Now it's I was looking at some models of the broadening top megaphone that some people had talked about. I looked at potential pullback areas. You can see we reached down to the first one and bounced. But those probably don't apply now, so let's take them off. Let's see if we can get some ideas for where we're going this week. So first thing I might notice is that Looks like we're at an all-time high on the S&P 500. We go into a weekly chart. Yep, we'll go into a monthly chart. And we are clearly at an all-time high in the S&P, which I already knew. I also know that if I put a lot more information on this chart, that we've been in a major uptrend since the bottom in March of 09. Up 211% in 1,448 trading days over the last 5 years. So we've had a big move in this market. And if I just switch this to a weekly view, tighten it up a little bit. Again, going back to the bottom here, we've had a very strong uptrend, rarely breaking below the 50 since 12, and the last time we broke below the 200-day moving average was back in 2011, before we had some of the quantitative easing. So now if we look at where we are right now, S&P 500 looks very strong. It closed up in the upper part of the day on Friday. Take a look at the Dow, similarly at an all-time high. Starting to get extended maybe from the 200. Haven't had a big pullback in quite some time, but you got to trade the market you have, and right now it looks pretty strong. Same thing with the NASDAQ, beautiful morning star forming on the 50-day. These are the weekly, my bad. Change that to daily. So let me go back real quick. So same thing though, Dow daily, all-time high, big pullback in October, which we've recovered from. The NASDAQ, similar pattern, just below a new high, sort of a spinning top on Friday. We'll see where we go from there. I look at the Russell, and I see, I don't know what I was drawing there. Let me pull those off. The Russell's a little bit different in that the Russell is not at an all-time high. And the Russell, you might anticipate, is going to have some resistance there. Whoops, where did I go with that? And still has to get above the most recent move there. So the Russell has not taken out all-time highs. It's a laggard, although the last several days it's had an up day after this pullback on Monday. We look at the dollar, if you want to see what strong looks like. Breaking out to multi-year highs. In fact, if I go to a weekly, you can see we are now have broken above the highs from 2011, and our next stop, and I have the black line because I thought this would be pretty substantial to get through, is 24. So we have a little ways to go to get to that 24, but we continue to lead. Now, the good news with the dollar strength is it makes things that you and I might buy from abroad cheaper. The bad news for the dollar strength is it makes our goods much more expensive to sell elsewhere, and therefore we run the risk that those U.S. companies whose earnings depend upon selling goods outside the U.S. may have some trouble selling those goods, and that could affect earnings and could be a negative on some of these multinational corporations going forward. The other impact of a strong dollar, you might expect gold to be weak, and despite the fact that we've had occasional moves on the gold in spurts, the gold remains relatively weak and is below, just below the support line I drew here at 115. So gold had a shooting star like on Friday and stopped at the 17-day. What worries me about gold is that it's got a lot of resistance to get through, a lot of, I guess, what they might call overhead supply. Silver also looks weak. Now, with gold and silver weak, one might expect the miners to be weak. One that I saw that looked actually pretty good, though, was Stillwater. And I always thought that Stillwater mining was a silver play. And I won't say this looks great. Let's go to a daily. But it looks better than the gold and silver do. It's actually up off of its lows. But it turns out Stillwater does a lot more than just silver. In fact, palladium, platinum, and other metals. So, but if this would only be if you want to look for some bottom playing in some of the metal stocks. And then I guess another one, if I had to buy a gold stock, that's not what I want. Royal Gold, and I can't remember what it's, our gold, maybe RGOD, or is that Rand Gold? Yeah, Royal Gold, it's hard to get excited by these. And it's got to get above its 200, but this is way off of its bottom. American Barracks, not as good. Allied Nevada, looks like American Barracks with a lot lower number. Yamani Gold looks the same. So Royal Gold looks different, but I still like to see some fundamental reason for me to get into the miners. And lastly, to look at the VIX. The good news is it's unlikely to get a whole lot lower before the market makes a change. The bad news is it doesn't show any of, I guess that's the good news, because if you're long, you want to see the VIX stay low. The bad news is it's kind of getting close to a place where we might expect to see reversals. But a low VIX alone, this VIX still has a ways to go before it's low. And to me, it takes more than just a low VIX. It takes a VIX that's rising to be a sign of market weakness. And right now, the VIX is low, but it's kind of where it's been for much of the last 6 months, or really last couple of years. Then I want to look at industry group rotation, and I could see that with my T1 view, I have 177 groups. And this is sort of your balanced, mostly the last 1 day, 5 day, and a little bit of 3 week view. And we can see up at the top, semiconductors, wealth management, some pharma and biotech. But I want to look in a shorter period of time. So specifically, let's look at my 2-day force up. And this gives me an idea of what's working now. And I have 65 groups that are strong. If I look at 2-day force down, I could see I only have about 10, but there are a lot of energy related, midstream and marine shipping index. Got some ag, some cement, steel, utilities, restaurants, REITs are the ones that were underperforming this week. So let's look at what's working with the premise of what was working yesterday is likely to be working again today. So we'll start with semiconductor devices. I right-click, change to index group, and I can tell you that these are all been on, many of these have been on a nice run, many of them are extended, but they've clearly been the leaders. Now I'm going to make my charts a lot dirtier, but it's what I use to trade. So remember my 8, 1750, and 200. Now I'm going to toss on a few other things. Up at the top are, see if I can, Okay, this is the bongos, which are a momentum indicator. This is force, the top one on the bongo and the force are my long one. The second one is the short term. In an uptrend, I would expect the long one to be green and the short one to go red during pullbacks. In the middle, here's accumulation distribution. This is my high jump bar, which measures extension. This is red candle high. These are green candle lows. This is a Bible gap up. That's a squeeze. That's a MOBO breakout. These are pocket pivots. This is on balance volume with the 10-day moving average. And these are my kahunas. And I don't need, it's about, let me take it in a little bit. Okay. And then these dots here are PSAR green, which is long, and red are shorts, are short. So we'll start with Avigo Technologies. You'll notice that several of these have some good earnings per share growth. This is not, it certainly does. This is a lower left to upper right. It had a Bible gap up earlier in the week here. Not sure if that was on earnings or not, but certainly a lot of strength in the market has been in this group. Avigo Technologies, it's had a big run. At some point, it's going to get tired, but it's a leader. Second one is Freescale. Less extended than Avigo. It's got some good earnings coming in. This one had been in a downtrend, had a reversal in October, broke out above the 200. This is the strength of the industry right there. I have interest in both of these stocks, and they're on my buy watch list for this week. Spansion is going through M&A with, should it be on this list, with having a mental block on who Spansion is merging with, but I usually don't play stocks that are moving because of acquisition, because if I'm not already in them, it's already had perhaps much of the big move. Skyworks, again, great earnings per share growth, lower left, upper right. So I hope, because we've talked about them every week, that you own either Avigo, Skyworks, or maybe Micron, another of the same pattern, lower left, upper right. This one is a little bit more robust of a company, perhaps, has been in a long-term uptrend. Let's look at a weekly chart. The problem with Micron is its earnings are clearly slowing down, but it's acting like it wants to go higher. So this has been a strong group. It remains a strong group, and one that I will potentially expand some of my holdings in. The next one is infrastructure software. We're not going to spend any time here because only two of the stocks are above the index group, and of those stocks, one of them, which is this one, Actuate, is a buyout, so nothing more to say about that. That's why it gapped up on big volume. And then the other one, we'll just take a quick look at Splunk. Splunk's been going sideways. It doesn't make any money. Not my, I don't think it's that exciting. I did notice that there is some popular stocks here, including Palo Alto Networks. Looks a lot like Avigo, lower left, upper right. Now, on HGSI, which only gives me the next 2 quarters, I don't see a whole lot of earnings. But if you were to go into MarketSmith and look out 2 years, you'd see 2016, they're expecting about $1.46, which is 100% growth. So there's probably a reason why this stock shows such great earnings strength. Symantec, not as pretty. Looks good, but not as good. That's the second group. Third group down is banks, and really the third and fourth group. So regional banks, several of them made the list. We'll just look at the first couple. There is clear-cut changes in the finance world, whether you're brokerages, wealth management companies, big banks or little banks, started to move. This is regions, and you'll find that you don't have a whole lot of great chart patterns in this list. This is sort of a sideways move, broke above the 200, 3 kahunas in the last 4 days. Mobile breakout from the squeeze in all green. Not great earnings growth. Here's SunTrust, relatively sideways, breaking out here from a squeeze with multiple kahunas and pocket pivots. Everything is green. U.S. Bancorp, sort of a left to right pattern, not very tight, breaking out here from a squeeze with a pocket pivot, a couple of kahunas earlier in the week. KeyCorp looks like the first one, Regions, breaking above the 200 with multiple kahunas. When I see a group of stocks with multiple kahunas breaking above major moving average and resistance, something is moving within this sector, and I think you picked your favorite one. Not only are little banks working, or regional banks, they're not so little necessarily, but so are diversified banks. And one that I have a big position in is Bank of America. And you can see Bank of America broke out this week. Kind of looks a little bit like Regions and the other. Multiple kahunas and pocket pivots. Had a mobile breakout from a squeeze, I think, on Wednesday. Everything is green up here. And what I especially like of Bank of America is if you were to look at earnings for Bank of America for 2015, they're looking at $1.48, which is a 222% gain. If they get their, if being a large two-letter word, and they keep a 32 PE on $2 or more of earning, or on $1.50 of earnings, that's a $48 stock. It's currently trading at $17.50. The PE will probably come in. I like to see the dividend go up, but I like Bank of America. JP Morgan Chase, similar pattern breaking out. Citi, ditto. Wells Fargo. So you have regional and big banks both behaving the same way, which is pretty much the definition of a wolf pack as these things are moving up together. Money clearly flowing into the banks. Communication equipment. Finisar is one that I thought was interesting this week. It's got some good earnings per share growth. And if I remember correctly, it's been one that had been beaten up, broke above the 50. And if I look on a weekly, I can see that this was a big, I guess not even showing up on the week, it's been going sideways for a while. I like this stock for a number of reasons. It's had a move from about 14 up to 18, so it's been a little bit of a move. And let me see what the earnings say here. FNSR. $1.35 in 2016, 30% growth. Maybe I don't like it that much. I must have been thinking of something else. But it did have multiple kahunas and a pocket pivot. You can see the strength of the industry growth, the mobile breakout from a squeeze. What I do like about this stock is this. If I had a job, I don't have a job anymore, I'm retired. So I do a little consulting. I can't necessarily be at my computer. So I like to find stocks that haven't broken out and gotten too extended yet and might be sitting in a position where I could project where I want to put a buy and where I want to put a stop, and I might make a conditional order. So this is a PSAR reversal dot. When the trade goes through that dot tomorrow, then you'll get a green dot underneath. To some folks, that parabolic stop and reverse is a buy signal. So let's pull my little drawing tool up. I could say that if we trade above here, that I want to buy. I should have probably done that green because that's a buy. And I can look here at the chart and say if I'm going to get in somewhere about 18, where do I want to put my stop? And I could put my stop perhaps right below the 50-day moving average, which the idea being that if it trades below the 50-day moving average, I don't want to be in this stock. And I go to work, I put in a conditional order that says, if Finisar trades above this line, I have a buy stop. I immediately put a sell order or a conditional stop order based upon the chart. And I'm buying this because it's broke above the 50, pulled back to the 50, and is moving. So if it was to pull back below the 50, I don't want to be in the stock. Now that looks like it's going to be about $1.50, which is a little. It's about an 8% stop. This is a really tall bar here. But by being close to that PSAR reversal dot, I have an objective, not subjective buy point. And if it hits it, I want to be long. If the market opens up down 200 points on Monday, I'm never going to hit it. So that's kind of why I like it. So Finisar looked interesting. Anything else in this group? Nokia? No, I'm not too interested. All right. Looks next group down is number 6, biotech. This has been one of my favorites, and this stock has been one of my favorites. And, I do this every week. I mostly do it for me, not for you. My wife asks, why do I do this? I don't charge anything. I do it predominantly because it's a vehicle for me to force myself to follow the same routine. And I notice I make more money when I follow my rules. And I hope you guys can make some money following the rules as well. This is Gilead. So very quickly, let's pull up a regular moving average chart. So Gilead has had a huge run. And the reason why I made the comment about why I do this, because I've been talking about this stock for 2 years. And for 2 years, I said, I remember a year ago saying, this is my sell gene of 2014. And if you had bought it a year ago, for example, you'd be up 35, 40%, or 35, 40 bucks, which is 50% return. Gilead has some great drugs. It has some warts, and that some people have come down against the company because of their cost of their drugs. But I can assure you, if you unfortunately have hepatitis C and given a choice of their drug or anybody else's drug, you would not care how expensive the drug is, because it can cure a disease that otherwise is an awful disease. So we've been in a nice uptrend. We had a pullback. We're right below that 50-day moving average. And my guess is if we can break above that 50 earlier in the week, we're going to go out and we're going to get and threaten those recent highs. So I'm interested in Gilead, and supportive of that is multiple pocket pivots in the last couple of weeks, a PSAR reversal, a mobile breakout, a squeeze, a kahuna, and breaking above unbalanced volume, and a PSAR reversal. So I like Gilead a lot. Biogen had been threatening and looked like a potential short opportunity down here, but it had a big move on some drug. How do I say it? I guess some on R&D, and maybe I think they also had a recent approval. Pocket pivots and kahunas. I still like Gilead more. This is another one of my holdings, Echelon. It's sort of stair steps, 1, 2, 3. Looks like it wants to run again. Expensive calls. These might be one to think about doing a cover right. That's what I did. I'm long at about 10. When it went up above 12, I sold $20 calls for $2 a piece, which reduces my cost. And I think this one's got a high likelihood of being taken out. They have a Hep C drug, which when combined with Gilead's product has 100% cures. And it had a PSA reversal. It looks like it wants to go again. And sort of the leader for some time has been Celgene here. And I think Celgene goes to 120, 130. But Celgene has, looks like it's slowing down here. But something to watch. All right. Next. This is top-down investing. You go through the top stocks. Airlines. We talked about them last week. What else can you say? Big cost of theirs is fuel. As the cost of fuel goes down, their prices go up. And whether you're in American Airlines or Delta or United or JetBlue, they're in a big run. I am in Delta, and then I thought this one had a big chance to move. And when it broke above the 50, I went into Hawaiian Airlines, and it's had a 50% move in 6 weeks. So I'm pretty happy with that. And the reason why I chose it was the chart, but also its earnings per share growth. So airlines remain strong. Specialty pharma. Several of these had good runs. Mallinckrodt bought the old Questcor, which would always be on the top of our list, and it's looking like it wants to break out. Everything is green, pocket pivots and kahuna. PSA reversals coming out of mobile breakout from a squeeze. And also Agios. I don't understand this one, but boy, do people like this stock. It's run from about 40 up to 112 in about 7 months. Their market cap is 3.6 billion, so I suspect they have a preclinical drug. Cancer metabolism, inborn errors of metabolism. Boy, there must be something to their R&D story. Mind you, these R&D driven stocks are extremely risky plays. Semiconductor manufacturers, that must be Applied Materials. And I guess if we're in the land of semiconductors doing well, then perhaps it's a no-brainer then for semiconductor material stocks to also be doing well. And Applied Material is the big kahuna here. And you could see from a volume signature, lots of pocket pivots, although it's probably not making it on moving averages. And the next one was ASML, which is an expensive stock. And lastly, in the top 10, wealth management. You can see stocks like Charles Schwab. So I'm not sure where Goldman Sachs is, and maybe I thought it had a good day on Friday, so let's just take a quick look at that as well. But whether you have E-Trade, TD Ameritrade, Charles Schwab, they all look similar. Goldman Sachs, I thought looked great. Breaking out. Morgan Stanley, breaking out. Lazard, not so much, but it looks like the same pattern here. Mobile breaking from a squeeze on Friday with a kahuna on big volume. I did my group inclusion report. I'm not going to step through it right now, but we can run through the stocks and take a quick look at them. Call them my GIF All-Stars. And remember, part of why I like these is they're usually big performers going forward. And they outdid the HGS 100 and the IBD 50 this past week. Activists, lower left, upper right, the old Watson Pharmaceuticals. We've had this discussed for 3 years. Advanced Auto Parts, all these have been doing well. AutoZone, Advanced Auto Parts, O'Reilly at an all-time high. Alexion, another biotech stock going sideways here. According to MarketSmith, earnings for 2015 $592, 14% year-over-year growth. What bothers me with Alexion is their year-over-year earnings per share growth is definitely going down. AmerisourceBergen, lower left, upper right. There's 3 companies in this industry. I've sold businesses to 2 of them, Amerisource and Cardinal. The third is McKesson. They're all great companies with operational excellence with only modest earnings per share growth, which is the only thing that bothers me, but they all have similar looking charts, lower left to upper right. AFSI, don't really know this company. It's a insurance play. Has been showing up on my screen for a number of weeks. Avago Technologies. Interesting, there's so many A's in the 30 stocks. Already looked at this one. Cavium, another semiconductor stock in the same group as Skyworks, Avago, and Micron. Celgene, we already looked at as a leader. Centene, this is an insurance company. It's one of my favorites. I actually have some of this. Lower left, upper right. They specialize in Medicare and Medicaid. And with the Affordable Care Act coming in and all the Obama-related types of insurance plays, they've been a leader. Electronic Arts, the game machine, breaking out. A bunch of pocket pivots and kahunas. EPAM, I think that's another it's a computer programming company. Don't know much about this, but it's technology which has been leading. Certainly a nice lower left, upper right. Horizon Pharmaceuticals, they had some bad news a few months ago. Stock has been going sideways. It's got some earnings per share coming in. In fact, if you look out in MarketSmith, 2014, 81 cents, 2015, $1.04. So that 2015 is $1.04 on 28% year-over-year growth. Well, why is the stock trading at 13? It's probably trading on news, but I think this is one of these Ian gas in the tank scenarios where the stock is going sideways, building up a lot of potential momentum with earnings growing. You see a kahunas coming in, pocket pivots. Here's the group strength, mobile breakout from a squeeze. I think this thing is ready to pop, and therefore I might be looking at this one on Monday. Log me in, lower left, upper right, leader, Manhattan Associates. I think this is another software play on malware. So it's business software. Nice move here. It looks like it wants to break out again with a couple of pocket pivots and a kahuna. Micron, we looked at this before, leader in the semiconductor space. MPWR, another semiconductor, analog mixed signal semiconductor, lower left, upper right. The entire group is leading this market. Noah Holding is a Chinese asset manager. I've owned this thing off and on. Earnings per share, $1.31 for 2014, 30% growth, $1.55 for 2015. I guess it's moving up on earnings growth. Look at the volume that came in this past week and a couple of viable gap ups. I believe the cruise lines are another entity that has major value from the low cost of oil. And whether you're looking at Norwegian, Royal Caribbean, Carnival, et cetera, this one's got probably the most impressive move off of the post-Ebola scare and breaking out to new highs. Here's another semiconductor stock, NXP. Open Text is the one that bought that company that I said I don't buy because I don't buy things that are under acquisition. I can't remember the name of the company. Other than that, not too exciting, but it did, somebody must have liked it. You had some mobile breakouts from a squeeze, pocket pivot and kahuna, and a PSAR reversal on Friday. Pebblebrook Host, there's a number of REITs that own a lot of hotels. Most of them pay 2 to 3%. This one pays 2.1%. Lower left, upper right. I'm a business traveler, and there's been a lot of new nice hotels that have come in owned by these different REITs, and they have high occupancy. Qualies, don't really know much about this. I think it's medical software, IT, malware. Okay, so it's more virus-related software. So that puts in the same world as PANW and others that have been really hot. Big move off of the 200-day moving average. Skyworks, same as the AVGO and Micron, NXP, and others. Spirit, another airline. Tessera, another semiconductor story. And they all look, I can't say they all, but so many of the semiconductor stocks look good. And Ulta, one of the few retailers that really looks strong, had a viable gap up out of a mobile breakout from the squeeze, a pocket pivot, and kahunas on Friday. United Continental, another airline, and United Insurance. So we saw earlier, AmTrust. This is another insurance company. These are not healthcare insurance. I think these are property and casualty are the ones that were making the list, and perhaps it's because we just got through another hurricane season without a hurricane and the decimation economic that they would cause. But nice pattern, lower left, upper right, pull back here to the 17. Looks like it's going again out of a breakout from the squeeze with kahunas. And lastly, we have Valiant, another Pharma stock, and a nice move up here. This one actually didn't move until activists decided to buy Allergan. This had been a big up move, kind of putting in a little bit of a cup and maybe a handle on the weekly stocks, weekly. And when I see on HGSI that the 2 quarters out is 0, that's because of the data vendor. It's not an HGSI issue. And I want to go to another data vendor, so I look at MarketSmith, and I could see 2014, 827, which is 33% growth. 2015, 997, which is 21% growth. So in 2015, if they have among friends $10 earnings and an 18 multiple, then I got a target next year another 180 to 190 um, on this stock. So one that might still be interesting. And lastly, VDSI, another company in the prepackaged software world or infrastructure design world rather, secure transactions over networks. And this was a stock that was less than $10 8 months ago, and it's clearly a leader at this point. So I've looked at a number of stocks, hopefully gave you some ideas, talked about the market. What do you do with that Hindenburg? You're careful. Doesn't mean that the market's going to roll over. It doesn't mean we have to have a market big correction. It just means that it's perhaps a little bit more likely now. But after the run we've had, we all know we've got a correction in our cards. The question is whether we get that correction before Christmas or in May of next year, and I don't think we know. So I just want to finish again with a promotion for our upcoming program with George Lee and I, and try and get some other special guests. Last year we had John Person, who was great here, and Jan Arps in New York. So again, February 7th through 9th, it's $800. My short email is hgsidoc@gmail.com. I can hold 40. We have good internet. We have 2 big screens and 2 high-def projectors, so we should be able to see everything. High, what, when, and where of trading. And our goal is to do live trading on Monday as well. Obviously, pending cooperation of the market. You all have a great one. We'll talk to you next week. Good night, everybody. Sorry if you heard my wife yelling in the background. She's a great lady, but sometimes we all get frustrated.